This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, in the last lecture, I explained and went through the example on planning and operational variances. We did example 1. That was on materials. And I said in the exam, you'll only be asked to do it on one cost, either materials or, as in example 2, labour. And I did suggest you had a go at example 2 yourself, because it's exactly the same logic, exactly the same approach. And so I won't have all the chit-chat with it this time. You can check, I'll just run through it quickly. Example 2, it is labour. So we're given the original budget. You've got there the standard cost. The original standards was we'd spend 8 hours at $4 an hour. The actual results, well, we actually worked 190,000 hours and we spent 769,500. Let's go straight into it. Let's calculate the rate of pay variance. The rate of pay variance. Let's do it the F2 way. Let's get the total variance, but then I'll analyse it into planning and operational. And this time, well, it's the same logic as what we did in the previous one. Instead of writing it all out in full line by line, I'll try and do it slightly quicker, but it's your choice. The important thing is to get it right, obviously. Either comfortable, as long as you're comfortable with it. For the rate of pay variance, always we take the actual hours worked. So we actually worked 190,000 hours. And we look at the difference between the actual rate and the standard rate. So actual hours worked at actual cost is 769,500. Actual hours worked at standard cost, original standard cost, is 190,000. It should have been $4 an hour. So it should have been, oh, right here, 190,000. Yeah, $4 an hour, it should have been 760. And so we've overspent by 9,500. So in total, there's an adverse rate of pay variance. However, let me immediately analyse it into planning and operational, because we're told below that since preparation of the budget, the price had increased to $4.10 per hour. I don't know why, perhaps it's just that wage rates in general had gone up and we'd have no choice, we'd had to increase it. But that permanent change is our planning variance. So the rate of pay, still on rate of pay, the planning variance just like in the previous example, for the planning, we're comparing the revised cost per hour with the original standard cost. So here I can write it shorter, because always it's the actual hours. So the actual hours, 190,000. Instead of writing the two totals separately, surely we're looking at the difference between the revised standard cost of $4.10 and the original standard cost of $4. So our standard cost has been revised 10 cents higher. So in total, 19,000. That alone, we expect to spend 19,000 more. So we'd now be expecting the manager to be paying $4.10. Let's check whether the manager did pay $4.10 or not. The operational variance And for operational, we'll compare what actually happened with the revised standard cost. Well, here we don't know the actual rate per hour, so we'll take the actual hours at actual cost. £769,500. And we'll compare it with the actual hours at the revised standard cost. So it was 190,000 hours. The revised standard, you should have been spending $4.10 an hour. So 190,000, $4.10, $7.79. And so what's the variance? I think it's 9,500 favourable. Does it add up? 19,000 adverse, 9.5 favourable. The difference is 9.5 adverse. That's right, the difference. The net is 9.5 adverse, which is what the total was. So in total, we're 9.5 adverse against the original budget. We've now analysed it. We're losing 19,000 due to the fact we expected wages to be higher. The manager seems to have done a fairly good job. That he's managed, even though we're paying more than the original $4, he's managed to pay a bit less than the $4.10 that we were now expecting. That's rate of pay. Finally, let's do the efficiency variance. Again, I'll do it in total first, the total F2 variance, and then we'll analyse. Obviously in the exam only do what's asked, but that's the most likely. What's the total? Analyse. So first of all, the total, the normal F2 variance. For total, we look at the hours, we compare the actual hours, 190,000, with the standard hours for the actual production, and of course the original standard was for 8 hours. The actual production was 24,000. So 24,000 units at 8 hours a unit, we would have expected to take 192,000. So we've saved 2,000 hours. Cost it out at the standard cost, $4 per hour. Overall, we've saved, it's a favourable variance of 8,000. Now let's analyse it. Planning operational. And the bit, the line at the bottom says, since preparation of the budget, the price per hour has increased to $4.10. The time has been revised to 7.5 hours. And so, let's do exactly the same again, but for planning variance. We'll compare the revised hours, standard hours, with the original standard hours. For operational, we'll compare the actual hours with the revised. So, planning variance, revised standard hours for actual production. $24,000 units, actual production. The revised, it should be 7.5 hours per unit. So we'd expect 180,000 hours. How much did we originally expect? Well, the original standard hours for the actual production, 24,000 production. It was originally 8 hours a unit. 192,000. It saved us 12,000. Or again, I could have written that faster. It's 24,000 units. We're saving half an hour on each unit. Again, 12,000. Cost out at standard cost. The original standard cost $4. 48,000 favourable. And finally, operational. Do it in exactly the normal way, but to check on the manager, instead of comparing the actual hours we worked with the original standard, we'll compare it with the revised standard. And so, actual hours, 190,000. How many hours should we have used? The revised standard hours for the actual production. 24,000 produced. The revised standard, 7.5 hours per unit. In fact, the manager has used 10,000 hours more than we would have expected. Cost out at standard cost, the original standard cost of $4. They use more hours than you now should have done, and so that's adverse. Does it check? 48 favourable, 40 adverse. The two together give us a net 8,000 favourable. Yes, and that's what we calculated initially, 8,000 favourable. Finally, just let me summarise these variances, and then I can have one last chat about them. As far as the planning variances were concerned, the rate of pay, what was it? Rate of pay for planning variance was 19,000 adverse. The efficiency where's it gone? Efficiency. The planning variance is 48,000 favourable. As far as the operational variances are concerned, rate of pay £9,500 favourable, and finally efficiency. I just had it, didn't I? 40,000 adverse. Now, the reason I've done that is because inevitably, if you get a full one of these, it would be in section C, and it would be either materials or it would be labour. But within section C, you will also be expected to write, to comment. Now, I did mention a bit in the previous lecture, and a lot of it depends, read the question carefully, what information's given. But I just want to add one thing here. First of all, operational variances, you comment in the normal way. We had that in the paper F2 lectures. It's likely to be two different managers involved. One's responsible for the rate of pay. Fine, seem to have saved money, but we'll still want to know how it happened and can it continue. The other, perhaps the production manager, is responsible for efficiency. Again, something's gone wrong there. We'll want to know what it was. So that's the normal F2 chat. Planning, though, the question is, why have we changed the original standards? The price per hour went up. Now, it could have been we were just forced to change. I mentioned that earlier. If wage rates everywhere else have all gone up by 10% or 2% or whatever, then we've perhaps been forced to put ours up. Cost us money, nothing we can do about it. But the other reason is this. maybe we didn't need to increase the rate of pay, but we've decided we'll increase the rate of pay to try and get them to work faster. Suppose that was the reason here. So we've changed our plans. We'll give everybody more money because they'll then work faster and save us money as a result. Well, we can now look at it and say, well, was that a good idea or not? Well, here it was. It was, because increasing the rate of pay has cost us money. But if that's the reason why we now expect them to work faster, then it was a good idea. I hope you see my point. The two together are favourable. However, although it looks like it was a good idea, you can add something else to it. Operational efficiency was dreadfully adverse. Perhaps that's because our plans weren't thought through properly. It looked as though it was a good idea. Pay 19 but save 48. But perhaps it was simply unrealistic to expect them to only take 7.5 hours. And that in fact, it's perhaps not the manager's fault at all that he's gone 40,000 over. Perhaps it was just unrealistic to have expected that saving in the first place. Now, we don't know, but that's the sort of thing you should be able to discuss briefly. They won't want great long essays. But don't just say good, bad, good, bad. Make sure, again, a lot depends on the question. The examiner gives clues in the wording. But make sure you can make some sensible comments. Do say good, bad, favourable, adverse. But you will be expected to say that bit more. Okay, well, that was the first of the, what you might call advanced variances. Planning and operational. The next one we'll do is something called mix and yield.